Good morning everyone. My name is Siddesh. Today I am talk about profit maximization. Profit maximization is a process business firm undergo to ensure the best output and price levels are achieved in order to maximize its return. In the business, profit maximization is a good thing, but it can be bad thing for a client. If, for example, lower quality material, labor are used, or if business decides to raise the prices for executing projects, all in pursuit profit maximization. Profit maximization process business firm undergo to ensure best output and price level its returns. Inflation factors such as sale price, production cost, output level are adjusted by firm's way of realizing its profit goals. Advantages of profit maximization model. First, economic survival. Profit is a vital the survival of any business. Second, measurement standard. Profits are the right measurement of the viability of a business model. In the absence of profit, the business loses its key goal, acquires direct risk to its survival. Third, social and economic welfare. In a business, profit demonstrates the proficient use and allotment resources allocation and payment of for land, labor, capital, and organization lends itself to the social economic welfare. Disadvantages of profit maximization. Profit definition is unclear. Different perceptions of a term exist among organizations and individuals. For example, profit can be gross profit, net profit, before tax profit, or profit rate. Second, time value of money is ignored. The formula based on the idea that higher the profit, the better proposal. But what about timing? In finance, when consider present value, we know the cash now won't have same value in the future. Third point, attention not paid to risk. In the percent profit, risks ignored, which may prove unaffordable at a time simply because higher risks directly question the survival of a business. For an example diagram of profit maximization. In the supply and demand graph, the output of Q is the interaction point of MR marginal revenue, and MC marginal cost, where MR is equal to MC. The firm is produced at this output level is said to maximize profit. If output produced less than equilibrium quantity as shown in the red part, where then MR is greater than MC and profit is not maximization, the firm has its interest to raise its output level to maximize profit because the revenue gain will be more than cost to pay. However, if the output level is greater than Q as shown in the blue part, the firm's overall profit will decrease because the additional unit produced will increase the overall cost. Here too, profit is not maximized and the firm is lower its output level of maximized profits. For a firm, the perfectly competitive market for its output revenue function will be simply equal the market price times the quantity produced and sold, whereas the monopolist which chooses its level of output simultaneously with its selling price. In the case of monopoly, the company will produce more product because it still make normal profit. To get most profit, you need to set higher prices and lower quantities than competitive market. However, revenue function takes into account the fact higher levels of output require lower price in order to be sold, and future holds for the fact the higher level of output require lower price in order to be sold. Then analogy feature holds input market in perfectly competitive input market. Firm cost of the input simply the amount purchased for use production times the market determine unit input cost, whereas monopolist input price per unit higher for higher amounts of input purchase. Principal difference between short run and long run profit maximization is that the long run and quantities of all input physical capital as choice variable, while the short run amount capital predetermined by past investment decision. In other case, here the input labor and raw materials.